Everyone wants to be able to retire a millionaire, but for most people, the thought of actually becoming a millionaire is nothing more than wishful thinking. That goal seems so far away, so distant, so unachievable that most people just give up before they even start trying. But the truth is, you're probably a lot closer to financial success than you actually think. So in this video, we're going to be talking about the 7 biggest investing mistakes that people make when they're first starting out. If you can just avoid these 7 costly errors, it's going to put you well on the fast track to financial success. So it should come as no surprise that the single biggest investing mistake that people make is to simply not invest at all. Investing is the process where your money begins to work for you and generate additional wealth for you. It's that true passive income that we're all striving for. Warren Buffett famously said that if you don't find a way to make money while you sleep, then you will work until the day that you die. And if you think that you can just save your way to financial freedom, that you don't need to invest, you're just going to save money, then you're in for a rude awakening. Let's just assume a scenario where you are able to save $1,000 a month. That's significantly more money than most people are able to save on a monthly basis. But if you were to achieve this high rate of savings, it would still take you over 83 years in order to save $1 million. Just let that sink in for a moment. So even if you started when you were 18 and got your first job, you would be 101 years old by the time you saved $1 million. It's just not realistic on savings alone. You have to invest your money. Investing mistake number 2, not having an emergency fund. Once people start investing, it's very tempting to try to throw all of your money into the stock market or into real estate or into whatever investing vehicle that you're going for. But you need to have an emergency fund set aside for those rainy days. At minimum, I suggest $1,000 in savings for everybody, but realistically, you should probably be looking a little bit closer to 3 to 6 months worth of living expenses as an emergency fund. And having this emergency fund is very important because Murphy's Law says that anything that can go wrong will go wrong. And it'll probably go wrong at the absolute worst time imaginable. So you need to be prepared for it. And that can be problematic because if you don't have an emergency fund set up, then that means that you're going to have to sell off some of your assets in order to cover your life expenses when things get rough. And that can be bad because it may not be a good time to sell. What if the market is down significantly at the point where you're struggling? In fact, more often than not, that is the case. If the economy turns south, you're more likely to get laid off from your job or downsized or something like that. So now you don't have that monthly income coming in. But if the economy is down as a whole, that means your stock portfolio is also down. So now would be the absolute worst time to sell. But you have to sell because you have to cover your monthly expenses. Now for this emergency fund, I highly recommend having your money easily accessible in a very liquid format. Something like a high yield savings account or something similar to that. Personally, I use M1 Spend. It's a program through M1 Finance, the stock trading platform that I use for all of my investments. They're going to give a 1% cash back on any uninvested money that you have just sitting in your account as your emergency fund. And they're also going to give you 1% cash back when you use your debit card to actually tap into that money. Now, 1% for a savings rate isn't very high for investment purposes, but it is about 25 times higher than what a normal bank will give. So it's a pretty good option. Common mistake number 3 that people make is trying to time the market. The stock market fluctuates on a daily basis. Some days it's up, some days it's down. If you're waiting for the absolute perfect time to invest your money into the stock market, you will be waiting forever. And that's because realistically there is no perfect time to invest because none of us have a crystal ball and none of us know what tomorrow might hold. Theoretically, the absolute perfect time to invest in the stock market is directly following a massive financial crash, something like coronavirus. But there's a massive problem with investing directly after a crash. And that's because it takes balls of steel to buy in when the economy is crumbling around you. I mean, think about it. You log into your stock portfolio and for weeks, the price is consistently going down each and every day. So if the price is going down, why would you want to buy into the market? That just seems like a counterintuitive time. But that's the perfect time to invest because you're essentially getting stocks at a significant discount. I mean, think about it. If you were to go to Walmart and get 50% off of a brand new big screen TV, that would be a fantastic deal, right? But on the flip side, if a stock suddenly goes down in value by 50%, everybody gets worried and they panic sells their portfolio. Nobody is looking to buy that stock, even though now it is at a fantastic price. So if you haven't invested for the last 10 years, from about 2010 to early 2020, when the stock market was consistently climbing and going through the roof, it was a decade of prosperity. If you weren't able to pull the trigger in the good times, what makes you think that you're going to be able to actually buy when the economy is crumbling around you? So instead of trying to wait for that perfect time, just simply start today. Timing the market is not nearly as important as time in the market. The longer you have your investment, the less it matters whether you bought at a good price or a bad price, because overall, given enough time, your investment will go up in value. Common mistake number 4, not automating your finances. We live in a digital age. There is no reason in 2020 that you should ever have to log on to make a payment for your credit card bill or your mortgage statement, or to transfer money into your investment portfolio. All of that should happen automatically. By automating your finances, it allows you to have consistent money transferred from your checking account over into your brokerage account, where that money will be automatically invested for you. And that's important for a couple of reasons, because if we have to manually do it, then chances are we're just gonna get busy in life and we're gonna forget. And that's gonna leave less money invested for us for our future. And since that money is now sitting in our checking account, we see that money, and when we see it in our checking account, we're much more tempted to spend that money and probably spend it on stuff that we didn't need to begin with. So the faster we can get that money out of our checking account and into this other account where it's out of sight, out of mind, the better. Common mistake number 5 that people make when investing is simply waiting too long before they actually start investing. Investing is kind of like going to the gym or starting that new diet. It's one of those things that sounds good, but we procrastinate and we put it off and we put it off and we put it off. We're always waiting for a better financial time in our lives to start investing. We justify it by telling ourselves that, well, I just don't make enough money right now to invest. So when I get that promotion somewhere down the line, when I'm making more money, then I will start investing. But it doesn't really matter how much you invest. The key point is that you start with whatever you can afford right now. Because if you start investing $100 a month when you first turn 18, then by the time you're 65, you will likely retire as a millionaire. But if you had started instead investing when you were 40 years old, you would have to save $1,000 a month in order to retire with the same amount of money. So now, just because you started investing a little bit later in life, now you need a whopping 10 times more money invested just to achieve the same results. Now, a lot of people can't do $1,000 a month, but most people could do $100 a month if they wanted to. So start with that, and over time, as that promotion does come, then increase your rate of savings and investing to 150, 200, 500, 1,000, whatever you can afford. Compound interest was described by Albert Einstein as being the 8th wonder of the world. If you give compound interest enough time, it will turn even small amounts of money into vast quantities of wealth. Investing mistake number 6, investing too much money all at once. When people first start investing, it's very tempting to look at how the stock market is doing on a daily basis because you want to know how your money is doing. But like most things, the stock market fluctuates in value. So one day it might be up in value, the next day it might be down in value. And sometimes the swings are pretty massive, especially right now with coronavirus, where we have had significant drops in a lot of the stock prices. So if you're not a seasoned investor and you're not used to those massive swings, then if you have too much money invested all at once, then that can be very scary. You can see your entire life savings get cut in half almost overnight. And that can be bad because that might lead you to panic sell at inopportune times when realistically you should be buying even more. You see, it's very easy to watch $100 get turned into $50 and lose half your value, but it's something else entirely to watch $100,000, your entire life savings, suddenly get cut in half down to $50,000. So start small and start experiencing the ebbs and flows, the good times and the bad times, and just become comfortable knowing the fact that the stock market is going to fluctuate. So by first investing just a little bit of money, it can slowly over time give you that confidence knowing that in the long run, prices tend to go up. And that helps you avoid that short-term mentality and panic selling when something suddenly hits your portfolio. And financial mistake number 7 that most people make is not investing with taxes in mind. Taxes for most people is going to be the single largest expense that you will ever have in your entire life. It's even higher than things like your mortgage payment, your student loans, or your auto payment. So if taxes are going to be your single biggest expense in your life, then it makes sense that if you can somehow avoid paying some of those taxes, then you will have significantly more money for yourself. And that's where investing in something like a Roth IRA comes into play. You see, typically when you invest money, you're going to get taxed a total of 3 times. You're going to get taxed at your job when you earn the money, and then as that money grows and pays out dividends, you're going to get taxed on those dividends. And finally, when you eventually sell your investment, maybe in retirement, so that you can actually live on that money, you're going to get taxed again on any capital appreciation. So you're going to get taxed 3 times on your money. But with a Roth IRA, you can avoid 2 of those times and only get taxed once when you earn your money. So by eliminating 2 of the 3 times that you're taxed, you will save significant amounts of money in the long run, simply because you're just not giving that money over to the government and over to the IRS. You're instead keeping that money for yourself. So if you haven't already, open up a Roth IRA and put all of your investments in that. Only once you max out your IRA for the year should you even consider investing in a non-tax beneficial account. So that's going to do it for us today, folks. The 7 biggest mistakes people make in their investing lives. If you found this video useful, be sure to subscribe, leave a comment down below. I love hearing from you guys. This channel is dedicated to all things personal finance related, helping you earn more, spend less, and invest the difference. And as always, I'll see you all again next time. Thanks.